Good morning, everyone. Hope you're all doing well on this fine midsummer's morning. I'm Patrick O'Regan, a corporate finance specialist here at Vico Advisory, and I'd like to welcome you to yet another Vico Masterclass. Now, I might be a little bit biased here because we do spend our days knee deep in Excel spreadsheets. However, over the next 45 minutes, Dónal is going to cut through the noise and demystify one of corporate finance most talked about and perhaps most misunderstood concept, EBITDA. We've all heard the infamous Warren Buffett line, EBITDA is nonsense. It's the kind of statement that sparks heated debates. But let's be honest, there really is a reason EBITDA keeps popping up in conversations from Wall Street to Main Street. And today, Dónal is going to unpack why. At Vico Advisory, we're all about simplifying complexity. From a base here in the heart of Dublin, we've been helping businesses, investors, and entrepreneurs make sense of the fast moving and often chaotic world of corporate finance. So today, Dónal is going to go through EBITDA and give us all a rock solid understanding and tell us why it's got everyone from boardrooms to bar rooms buzzing. We're going to have time for Q&A at the end. So at any time throughout this webinar, please put your questions into the chat where we'll be moderating. So without further ado, let me hand it over to Dónal, who's going to dive into the nitty gritty of EBITDA and show you why, used the right way, it's anything but nonsense. Dónal, over to you.
Thanks, Patrick. Really appreciate that. Welcome, everybody. Thanks for joining us. I'm actually calling today from Mount Juliet down in the beautiful Kenny, where I got married a number of years ago. Thrilled to be here and thrilled to have you all with us. So for starters, who am I? I'm obviously the founder and owner of Vico Advisory. I'm a chartered accountant, chartered director, and for the previous decade plus, I acquired, managed, and operated a number of technology and services companies on a global basis. What I do now is I work with CEOs and management teams of SMEs to try and help them scale their business, try and help them grow via acquisition, and also to try and help them exit their business at the right time. So yeah, that's really what we do at Vico Advisory. And what really drives me is really just making people, I suppose, more engaged and more educated around this entire process. Without further ado, I'm going to take you through the agenda for this morning. So we're going to talk about what is EBITDA, why is it important? And then we're going to talk about how different acquirers and investors consider EBITDA when making investment decisions. We're going to talk about some specific accounting estimates that impact it. And we're going to talk about some acceptable adjustments to it. And we're going to talk about how to successfully represent it for valuation purposes. I'm going to touch on maybe one or two examples where EBITDA was potentially misunderstood and the impact that had. Then we're going to talk about a couple of recent EBITDA multiples for specific sectors these are sectors that we certainly focus on anyway in our business. And then finally, we're going to wrap up then talking to you guys about how to engage with potential acquirers. Even if this is something that's a while off, it's always great to get a better understanding as to what the process is and to be forewarned for it for times to come. And then we're going to talk to you just quickly about how we support businesses ourselves. And as Patrick mentioned, then he'll be running Q&A. So without further ado, we'll kick off. So EBITDA obviously stands for earnings before interest, tax, depreciation, and amortization. But what we've done here is on the right-hand side, you'll see I suppose a kind of a quick table that we put together for just an engineering company. We just use that as an example. You can see there, you've got revenue growing nicely to 10 million in 2025. And you've got cost of sales in there, and gross profit is coming in at somewhere in that kind of 35%. You then obviously have your SG&A or your operating expenditure, which takes us down to EBITDA. So in this context, we've set up kind of a 10% EBITDA margin. I think the key point to take from this is something that you may or may just know about, or something that you may or may not know about. But EBITDA, I suppose it's a really important measure of profitability for the financial period in question, because it takes the capital structure, the tax situation, and the banking arrangements out of the equation for a prospective investor or acquirer to consider. It's also a good proxy for cash generation, especially for businesses that are capital light. Obviously, for more capital intensive businesses, that's not going to be the case, but certainly for people related, which be services related or technology related businesses, EBITDA can be a very good proxy for cash generation. And then finally, it's a really important metric that does enable stakeholders to benchmark businesses against other businesses. And it's commonly used as a metric where the valuations are established because of what I just mentioned there, because investors want to consider what would the business look like in our ownership. So I suppose the next point is around how acquirers or investors consider EBITDA when they make their decisions. And what we wanted to do here was just at a high level, and I suppose touch on what different metrics different investors look for in businesses. So starting at the top, really, the angel investors, they come in at a really early stage in a business's journey. So they're not really focused on EBITDA. As you can see, they're all about the team, the opportunity, and what early traction the business has had. Venture capital firms, again, like they're coming in at a later stage, but they're more focused on growth. Businesses that they look to back, they may not have gotten to break even yet, and they may be more, I suppose, focused on what's the market size, more around margins. Are you getting your unit economics right? And what's your cost of conversion? And also what's the long-term value of your clients? It's really private equity firms are really the first potential investors who really look at EBITDA properly in our views. The reason why is because they're coming with a checkbook at a later stage in a business's life cycle. And so they're considering EBITDA, cash flow, and the ability to raise debt to potentially acquire the business. Similarly, debt funds there and lenders, they really focus on EBITDA because they use EBITDA as a measure of assessing what debt can we actually apply to this business without breaking it. And they also have a number of other, I suppose, metrics that they look at, like fixed charge coverage and liquidity and recurring revenue, as I mentioned there, which we can talk about in perhaps maybe another session in a more detailed manner. Public equity investors, they use EBITDA in a slightly different way again. They have things like price earnings multiples, and they would use kind of enterprise value to EBITDA multiple metrics as comparisons, enabling them to consider, should I exit the stock? Should I go long on this opportunity? But they'll also look at DCFs, discounted cash flows, return on equity, and whether a specific decision that a management team makes is accretive to the stock price. And then finally, corporate acquirers use EBITDA in a slightly different way again, because they're all about the strategic fit. They're thinking about what synergies can we have from or extract from the acquisition of this business. And as a result, then they consider, I suppose, what the pro forma EBITDA and going to be in our ownership. Yeah, so I think these slides actually just touch on that in just a slightly different or a slightly more detailed manner. Some of it comes down to the investment horizons, as I mentioned, as well, and others come to the integration and the one-off costs that exists in M&A. The next point I'm going to bring you to is around the specific accounting estimates that frequently impact EBITDA. And again, look, this session isn't specifically for accountants. It's more geared for CEOs and CFOs, perhaps, who want to learn a bit more about how to manage a business, especially with regards to having one eye perhaps on an exit. I just want to preface that before we talk about this is a relatively high level overview on how specific accounting estimates can impact it. But at a high level, these are the things that we often see when we're going through either due diligence or else when we're getting a business ready for sale that can have an impact on EBITDA. So the first one really is deferred income. And this comes to the point of really the timing of when revenue will occur or when it will be released to the P&L from the balance sheet. And what I mean by that is, so imagine you're a technology company and you sell licenses and you charge your clients for the full value of that license for that yearly license upfront. So what you should do then as a business is you should recognize the entire value of that license as a credit balance, deferred income liability balance in the balance sheet, and then you should be releasing 1/12 of that total value into the income statement as revenue each month as each month goes by for the entire kind of year of that license. And that's generally best practice on a global basis, really, be it Irish GAAP or IFRS, really. And we'll touch on this later. That's an area that I suppose a lot of companies can find difficult to get right, and also where they can trip up, especially with regards to how EBITDA is calculated. Similarly, accruals, so both accrued income and expenses can have an impact on EBITDA. So what do I mean by that? So these are estimates that I suppose management teams make with the best knowledge at that specific time, especially if they're not sure about what the value of specific revenue is going to be at a specific time or expenses are going to be. And as a result, when you then subsequently know about the value of that revenue or that expenditure at that time, at the subsequent time, you then obviously have to make an adjustment to cater for the fact that you now know what those figures are. And there can be a difference there, which can impact EBITDA. Provisions can obviously have an impact on EBITDA, and obviously there are very specific and strict criteria that need to be adhered to for someone to have to recognize a provision under IFRS. which we're not going to go through here, but they can have an impact on EBITDA as well. Revenue recognition, I have touched on it earlier on just there a minute ago, but especially with regards to knowing the value of a specific product or a specific project, perhaps maybe it may be overinflated or undervalued as a result. So that can have an impact on them as well. And then the final specific accounting estimate that we've included here is really around leases. And obviously, look, the difference between a finance lease and operating lease is really all around the transfer of risks and reward of ownership. And at a high level, a finance risk, the lessee essentially takes most of the risks and reward of ownership. And in an operating lease, the lessor retains those risks and rewards. There have been quite a few changes in this. The previous accounting standard, IAS 17, has been replaced by IFRS 16 in the last number of years. And there's no real change from a finance lease perspective, as you can see, but there is quite a substantial impact there from an operating lease perspective, where, after IFRS now, where there would have been a rent expense previously, there now is none. And so as a result, that's a reduction in expenditure and an corresponding increase in EBITDA. So the next point I'll take you through is really around what acceptable adjustments we often see and we would consider for businesses when they're representing an adjusted EBITDA figure. And I suppose for starters, why would you do this? And the key point really here is there are one-off events and transactions that can occur within a business and that won't be occurring going forward. And it's important to consider that when you're valuing your business for whatever purpose that is. And so there's 4 or 5 buckets that we're going to bring you through here in terms of these acceptable adjustments. But the first is really around that non-occurring piece. So these are unusual, infrequent events. So it might be a one-time legal settlement or restructuring cost or individual severance. It could be some asset write-offs or impairments. Say if you have to do a revaluation of a specific asset under accounting rules and it had to be it had to be impaired, then that could be, you could argue that could be a non-recurring item that should be added back from an EBITDA perspective. And then also things like natural disaster losses, unusual here, but can happen. And COVID-related costs in some respects. Obviously not blanket COVID-related costs, but if only, but some COVID-related costs could be potentially added back. Non-cash items then, so share-based comp, so stock options, in particular, unrealized gains and losses, bad debt provisions, and depreciation and amortization. I would think that a lot of that might be just known generally, but it's important to include it here again. The third area is really around non-core, non-operating items. So this might be less common to see, but gains and losses on disposals of assets or investments, that could be considered certainly as a legitimate add back. Investment income or expenses, depending on the nature of your business. Obviously, if you're a financial services company, it's not going to be added back. But if that's an unusual item for your business, absolutely. FX gains and losses, and then income or expenses from discontinued operations. Again, this will only come up if you stop a specific product line or like a material product line, say, or a material part of your business during the financial period in question. The management adjustments or pro forma adjustments. And so again, this is more focused in M&A or financing scenarios. I suppose if I were to acquire a business and we acquired it on the basis that we knew that we could let go a lot of staff without breaking the business and that we could continue to grow the business. Obviously, there's going to be a cost related to that big kind of severance, but there's a significant runway cost saving there that going forward, we're going to have the benefit of. And so that needs to be reflected in the adjusted EBITDA figure, but it has to be supported with real figures. And so there's a lot of work that needs to be done to detail that out. But we've done that very successfully over the past with clients. Normalization of executive compensation is certainly something that we see in every deal, to be honest. That can be quite often because SME CEOs, they might pay themselves a little bit more than the market rate. Sometimes we see them pay themselves a little bit less actually to try and make their business look more attractive to potential acquirers. And good savvy potential acquirers, they'll see through this and they'll know what the market value of that role will be and they'll adjust accordingly for it. But at the same time, it's always worth trying to see what you can do there. There's always something to be done. Costs related to acquisitions, this might be like corporate finance advisory fees, for example, or legal fees or LPOs. And then less so, we would see startup losses for new business lines. This could be quite a difficult argument to have because of the fact that, especially if that business line is going to account for future value in the business and that the prospective acquirer is buying into that future business line. And then I think the final one is more of a technical matter, which touches on what I mentioned earlier on about finance and operating leases. It's around IFRS 16 adjustments. It's just about adding back IFRS lease depreciation and interest, or deducting actual lease payments. So again, that's more technical, I suppose. More than happy to talk to you about that in greater detail on another occasion. But I think, look, the key point that we want to get you guys to think about in terms of how you should consider what adjustments you should add back to EBITDA, if you're going to do it, is, listen, transparency is critical. You have to justify and explain everything appropriately. And that can be difficult to do sometimes. It should be consistent, so that should be across different periods. So, for example, if typically a potential investor or acquirer will look for the previous 3 to 5 years of financial performance and position. So they would look for you to provide them with those same add backs across that entire range. Materiality, you should only really consider very material, I suppose, adjustments. And then the final piece is around, it has to stand up under scrutiny for both auditors and potential acquirers. So if it's overly aggressive or unsupported, it's not going to fly. So that then brings us through to the next part of our presentation this morning, which is around how to successfully represent EBITDA for valuation purposes. And I suppose what we've done is we've continued on with our ABC engineering services business, which, I suppose you might remember these numbers from the previous table that we showed. So we're just showing basically a continuation of that P&L, starting at EBITDA in this case. So we started EBITDA, we have our depreciation finance costs, our income expense then to get us to net profit. And then what we're going to do is we're going to add back, we've just included a number of these areas that we just touched on, and it's just hypothetical figures. And what we're saying here is, so you'll see there one-time legal fees, asset impairments, unrealized gains, and FX. We even have some M&A related cost saving and synergies. Like, we're just assuming that, I suppose, they've had a lot of ongoing things over the last previous years that would be one-off in nature. And I think the key point that we're trying to get you guys to think about here is, so if you look at the total EBITDA add backs there of €415,000, say, in 2025, so we're adding that to the EBITDA of $1 million to get to 1.415 million. So if we were to consider, I suppose, the difference between the valuation that a prospective investor or acquirer might place on this business, and again, for an engineering services business of this scale, they might apply a kind of a 6 or 7 times EBITDA multiple. But if they were to apply a 6 or 7 times EBITDA multiple to EBITDA, which is quite often what people would use to value their business, and that's 6 or 7 million of an enterprise value. But I suppose if they were to do using this adjusted EBITDA figure, it's 6 or 7 times 1.4 million, which is in around that 8.5 million, I think. Mark, I might have my maths wrong now, but basically the difference is it's quite substantial. It could be in the region of 2.5 million in this context in terms of enterprise value, which is quite a difference. And look, obviously, as I said to you before, it's not straightforward to have a buyer buy into all of these adjustments. And they obviously, as I said, have to be really well justified, really well detailed and consistent, and all the things that I just mentioned there. But if they are legitimate, and if you can stand behind them, then I suppose, why wouldn't you include them? So I suppose that's what we're just trying to highlight in this slide. So I think, Patrick, I think we were going to jump in there, were you?
Yeah, so Dónal, you've given us a really extensive overview of the theory of EBITDA. Can you talk us through a real life example where EBITDA was misunderstood?
Yeah, thanks. We had a transaction a number of years ago, large IT business, probably doing the guts of 100 million of revenues. And what happened was a very complex product offering, and then that fed into quite a complex, I suppose, charging and accounting setup for the business. And what these guys were doing was they were selling long-term contracts for their customers, usually 3 to 5 years and potentially even longer. And what was happening was they, as I said earlier on with regards to deferred revenue or deferred income, what they should have been doing is they should have, like, when they charged for their services, they should have been crediting that liability in the balance sheet and then releasing the portion that they were allowed to do so from an accounting perspective into the income statement at the right time. But what these guys were doing was, we found out during due diligence, was they were booking revenue too soon, which overinflated their revenue figures. And obviously their cost base remained somewhat similar, right? So across the periods as they grew, it grew in conjunction or with that revenue. And as a result, it had an impact of overinflating the EBITDA of the business. And that was spotted. And I suppose there was there were some difficult decisions that difficult conversations to be had, and it got very technical from an accounting perspective because it was a European company that didn't operate under IFRS; it operated under its local GAAP, which was different to our clients. And what happened was the impact and the fallout of that was the business was acquired, and it was acquired for quite a sizable amount of money, as you can imagine, decent sized business. But what subsequently happened was, I suppose, due to the changes or due to the different accounting policies that our client had, they had to change up how they actually accounted for these contracts and during their ownership. And what happened then was after their typical hold, which was, I think, in that kind of 5, 6, 7 years, they when they tried to sell the business, what happened was potential acquirers said, because of, I suppose, these changes that you've had to make, the business doesn't look now as attractive as we would like it to be. And so they found it a little bit more difficult to sell the business. They did eventually sell it. It did have wide-reaching impacts on the business. And that was really down to, as I said, I suppose the specific justification or consideration around how that accounting policy applied to that business across, I suppose, different jurisdictions. It can happen, I suppose, relatively easily where you don't take the time to really understand the true impact that change in, I suppose, in an accounting policy is going to have on a business's EBITDA. So it's really something to be wary of.
Super. Thanks for that, Dónal.
Yeah, no problem. We're going to talk you through, I suppose, some recent EBITDA multiples for our specific areas of focus in Vico Advisory. These are the areas that, look, obviously we are sector agnostic, but because in Ireland it's hard to be a sector specialist. However, having said that, we have specific experience in these sectors. We've built businesses in them in the previous decade or so. For engineering services businesses, typically for mid-market size businesses, and what do I mean by that? Anywhere from kind of 1 to 5 million EBITDA businesses would typically trade at anywhere from 6 to 10 times. They can be higher than 10 times depending on growth and scale and whether it's a platform and what the management team is like and all that good stuff and whether they've done M&A previously. But typically speaking, that would be what we would see. Testing, inspection, certification, compliance. We've done a hell of a lot of work in this space over the previous decade. And these businesses tend to trade for a little higher. The reason why is because, I think anyway, personally, the main reason why is because a lot of their work, it can be regulatory requirements. And as such, it's stickier revenue. It's really contracted in a very nice way. And so typically speaking, we would see them trade for anywhere between 9 to 15 times. And again, that will depend on the scale, the recurring revenue, management team, their experience. Healthcare technology, we just broke out healthcare technology from healthcare services because there's quite a wide variance here. I think the reason for that is because healthcare is infinite. We will all need healthcare at some point in our lives, and the cost of healthcare is only going up. So that's why we looked to get involved in that space. And as a result, quite often we saw larger EBITDA multiples being paid for businesses in this space. But again, this comes back down to technological advancement and the scale of the business in particular. In the services space within healthcare, it's possible to buy businesses for smaller EBITDA multiples. We've included quite a wide range there because quite often, I think a lot of these businesses, there can be quite a lot of synergies that can be generated from them because especially for traditional services business within this space, there's quite often a lot of people involved. And then I suppose larger businesses that have maybe a tech-enabled element to their business, they can trade for quite a lot these days. Financial services and technology, they're probably trading in that kind of 8 to 12 times or higher for high growth SaaS businesses. And similarly for IT managed services businesses, they might trade for a little lower, perhaps maybe, but there's a lot of movement in that space at the moment as well. And then, we've just included here a few factors that do impact these multiples because this is important to consider too when you're trying to build your business. I suppose the strength of the management team, experience of it, the technological advancement, as I said, and I think the key point here is on how entrenched that is within the company's operating business model. The reason why I include that is it's really, everyone can say they're involved with AI or to some degree now, but if you really have it really properly entrenched within your business, it can nowadays generate quite a significant multiple for if you're looking to sell your business. The scale of your business. So obviously the bigger your business, the more difficult it is to replicate, probably the better market position you have and the more customers you have. And so the more stable the business is, so the higher the valuation. The strength of the barriers to entry, this is, I suppose, can be a little bit overlooked, but it's something that we always would consider how difficult it is to replicate your business. This goes back to Warren Buffett's kind of concept around what moat are you building. And there can be various different types of barriers to entry. You could have just market share, you could have marketing dollars, you could have intellectual property, it could be distribution channels or networks, it could be government fiat, it could be, you could be an association, you could be a certification body. There are a range of different barriers to entry that we experience frequently and that we like to see when we're working with clients. Whether it's a platform for M&A, so what does that mean? It means, have you completed transactions already, or are you ready to complete transactions? What we always say to our clients is, if you're looking to sell your business, especially if you're looking to sell to a financial buyer, private equity firm, quite often they're looking to acquire your business, but also to find bolt-on acquisitions. So if you can come to them with a list of bolt-on acquisitions, and even not just a list, if you've already started conversations with them, that can be something that they would consider to be quite attractive. And then the percentage of recurring revenue. So this is at the start of each year, how much revenue do you need to generate to make your budget, basically. So if you have 70% recurring revenue business, then you've got to find an extra 30 to make your 100% for the next year budget. That's obviously not going to be as well considered when compared against a business that has 95% recurring revenue, say for a SaaS-based business. The degree of customer concentration is also really important. So depending on your business, obviously, what we often see is a lot of businesses can have a small number of large clients, and quite often they would be reference clients that would have started with the business and might have been the first couple of clients that a business has, and would have been very important for a time during a business's early life cycle. But perhaps now they're quite so sizable, and there is a risk now that they potentially leave unless you keep on providing them with the products and services that they are looking for. But it's always important to try and reduce the reliance on those large businesses by having quite a substantial number of smaller businesses as clients. Then the place in the industry. So are you first, are you second, are you third, are you last? That can be more or less important to some potential investors. And then finally, there's no point in buying a business if its growth rate is going down, or if it's stagnating, or even if it's a growing business in an industry that's stagnating or going down. Like I'm reminded of Kodak, for example, back in the, I'm going to say early 2000s, where that perhaps might not have been a good investment. And even I think of Nokia as well, who just did not move with the times with regards to PDAs or like phones with apps on them. So we're going to talk you through just at a high level how to engage with potential acquirers. We find that it's a nice kind of tie-in with most of the things that we talk about, actually. So imagine you have just received either an unsolicited call or meeting with, or even a term sheet. Actually, we'll leave the term sheet for now, but just someone has reached out to you and they're interested in potentially buying your business. So just a high level, few steps: be polite, be professional, be businesslike. We always say there's no, like, a conversation, you never know where it's going to go, and it never hurts to have it. Sometimes we see people who are a bit, I suppose, guarded, and sometimes they're right to be, yeah, absolutely. But generally speaking, we think that conversations are good. But having said that, though, it's important to confirm that they're genuine in their interest, and consider whether, say, for example, if it's a private equity firm, consider whether they own a business that competes with you, because you only should be sharing what you're comfortable with. And, and what we also say as well is you should signal to them that we actually get quite a few inbound interested parties come knock on our doors, even if that's perhaps maybe not the truest thing. But establishing an element of, I suppose, the interest in your business can go a long way. But we always say to genuinely engage with a corporate finance advisor, whether it's us or someone else, early to manage these discussions, because an awful lot can be lost in translation, and there can be a lot of expectations set, and there can be things that may have been verbally agreed to, which subsequently you may not want to agree to. And having someone, by your side early on in that process is very important to guide and shepherd you through it. So if you sign an NDA, then a non-disclosure agreement, and if you continue on with your conversations, be transparent, but manage the information flow carefully. Yeah, absolutely. quite often the flow goes, potential investor will ask you, might send you a list of, I don't know, maybe 10 things, high level information about your business. And they might try and go back again, but I'd try and hold their feet to the fire to really assess how genuine they're interested in. And look, guys, if you're interested, send us on a term sheet. And we're happy to consider what valuation structure you might apply to our business. I would work with your corporate finance advisor to have them review it and negotiate the term sheet. And I would say then, if you do agree on it, then, grant exclusivity for a short period of time, a reasonable amount of time for them to complete some due diligence. What I'm talking about here, by the way, is only a bilateral kind of one-to-one conversation between you and a potential acquirer or investor. I'm not talking about a full sale process, because that's a whole other conversation. We will run other webinars on how that process works. But yeah, and then so prepare in advance with your corporate finance advisor to streamline due diligence. And really, what we try and do with our clients is really to work with them in advance to get their business ready for sale, because you can never be prepared enough for, I suppose, the due diligence process. As the process continues, there will be legal documents. They'll be based on your term sheet. Your solicitors and your corporate finance advisors will handle those negotiations. You'll be given input on certain important areas like warranties and indemnities. Again, we'll run a session on what this means. But basically, these are things that during due diligence that a potential investor will identify as being risks in your business, which they're not, I suppose, either they're not happy with, or they're perhaps maybe they want you to be on the hook for, things like that. And there are differences between warranties and indemnities that we would go through, but you would have to be comfortable with some of these. But the key, though, for CEOs is when you're in meetings with potential acquirers is to use them genuinely to consider whether there's a good chemistry there, because you're going to go through good and bad times with these guys. So you have to be comfortable with them. So look, that's a whistle-stop tour of what EBITDA is all about. Vico, we provide advice and support to businesses, mostly SMEs, both on the sell side. We work with larger players on the buy side. We do some debt finance advisory, and we assist on post-merger deal integration as well. We are sector agnostic, but we have built up quite substantial businesses in these industries, each of which would probably be in that kind of 100 million revenues plus over the past decade. And we're always keen to learn more, and yeah, we'd be happy to talk to you guys about any of your businesses. So without further ado, I'll pass it back over to Patrick.
Thanks, Dónal. That was really good unpacking EBITDA, and have been moderating the chat, and some interesting questions have come in. But before we go into them, let me lead with the first question, if you don't mind. And it is a long one, so be prepared. If EBITDA can sometimes mask the real health of a business, as critics like Buffett argue, how can business owners or investors make sure they're not being misled by it? And what are the key adjustments or red flags you look for when assessing EBITDA quality in a deal?
Right, thanks. Yeah, I think the more I look at different businesses, the more I learn about what they should look like from both an operational, a financial, and a strategic perspective. And specifically financially, when you look at enough P&Ls, cash flows, and balance sheets, that like I do, you get a good sense as to core metrics that a business like that should be operating on, and all the way from revenue growth to EBITDA margins to cash flow, I suppose, generations, like EBITDA to cash flows, conversion rates. And I suppose where things stand out, they're either due to two reasons. One, you might have a phenomenal manager there or leader who's able to, I suppose, to drive a business way better than their competitors. Or alternatively, the other outcome that we often see is they're doing something funny with the numbers. And so that's why I do genuinely think that engaging with someone like a corporate finance advisor who is in the detail day in, day out in your industry makes a hell of a lot of sense, because they just spot these things quite quickly. So I would say that the biggest mistake I see in people in trying to assess these things is not actually really leaning on the advice of those who are in it day in, day out.
Super. Thanks for that. And we're going to go to the questions now. We had one come in from Barry. Hi, Dónal. Any EBITDA multiple ranges for engineering and manufacturing businesses that are mid-cap?
Yeah, okay. So engineering, manufacturing. So what I'd say there is manufacturing businesses, they're quite capital intensive, right? There's quite a lot of ongoing investment that's required. And so it really comes down to the potential acquirer or investor, whether that's their specific area and whether they're comfortable with that ongoing investment. But what I would say is it does come down to a couple of the other things that I mentioned earlier on in the presentation. But yeah, anywhere in that kind of high single digit EBITDA multiple range would make sense to me, Barry. And then depending on the scale, depending on, I suppose, as I said, the management team, depending on the market opportunity and the platform capability, you could push that a little higher. But I would think that's where you're thinking. It's not lower than 6, and it's not higher than 11. I think that would be my gut on it anyway.
Okay, thanks, Donald. The next question came in from Chris O'Reilly. You mentioned the importance of adjusted EBITDA and valuation. In your experience, which adjustments tend to generate the most pushback from acquirers during due diligence, and how can sellers best defend them?
Really good question, Matt. Yeah, I think that's a tricky one to answer. It really depends on the specifics, but adjustments that we see get pushback on quite often will be around things that require an awful lot of management estimation, and around that, what we would see is really around adjustments that are based on the future performance of the business. And so what I'm thinking there is stock-based comp for a management team, for example. That's one that we sometimes see as being perhaps something that a potential acquirer would question, because how can you know what the future is going to bring, and therefore the value of that stock-based comp? So I think that things like that, where there's an awful lot of management estimation required, that definitely has more of a pushback.
Perfect. Then we have a question in from Paul. Taking EBITDA as a read, is there a preference or bias for either guideline public co-multiples over guideline transaction multiples?
Guideline public co-multiples versus guideline transaction multiples. I think you'd need to give me a little bit more detail on that, Paul. But I think what you're asking is transaction multiples around business A buying business B versus publicly listed company multiples. Is that where you're going with it? And if so, I think that what I would say is, whenever we're working with a publicly listed company, obviously the whole idea of them acquiring businesses would be for the transaction to be accretive as soon as possible, if not immediately. So obviously our baseline is, if you're trading at an EBITDA multiple of 15 times or 14 times, whatever it might be, we're obviously trying to complete transactions at lower multiples than that and would frequently do, to ensure that out the door, that business is immediately accretive to their share price. I'm not sure whether that's answering your question, but I hope it is. And Paul, if you want to touch on that again in person, I'd be more than happy to do that at the next time I see it. Have you any more questions, Pat?
One just came in to me directly. We often see businesses presented with adjusted EBITDA figures in pitch decks. How do you separate fair adjustments from creative accounting?
Really good question, Patrick. I think it comes back to the things that I mentioned earlier on around, I suppose, consistency and also transparency, and whether they stand up under scrutiny and materiality. Because it's funny, right? We've all met that creative accountant who pushes the envelope out and puts in quite aggressive adjustments to EBITDA. And sometimes I see them go through, and sometimes a prospective acquirer won't pick them up. But what I find is it's all about the questions you ask, and I think the understanding you can gain. And I find that if that accountant can't, in layman's term, explain to you what it is that they're trying to achieve, it's usually something that it's far too aggressive an adjustment. And so I like to just take a step back and actually just look at it at a high level perspective and get them to talk to me through it as if I knew nothing about the business or about accounting. So I think that would be the number one thing that I would, I suppose, look out for with regards to reasonable adjustments versus creative accounting.
Perfect. Thank you for that, Donald. And I think, just conscious of everyone's time, I think we just might begin to wrap things up.
Yeah.
So look, for those of you lucky enough to be on today's call, Dónal is providing a complimentary 30-minute session for you and your business to discuss any of your pain points. So if you scan the QR code there, you'll be able to book a free 30-minute appointment. And we also are providing a quick cheat sheet on the importance for EBITDA. And then some more housekeeping from our marketing. And yes, Grazieli, I see you behind the screen wanting me to push this hard. So if you could follow us on LinkedIn and on YouTube as well, because we are creating longer content for YouTube to be more actionable insights for our audience. And again, we have, if you enjoyed today's masterclass, and we hope you did, it's not too far away from our next one, which is August 28th, which will be a really interesting one on the role of due diligence in a successful M&A transaction. And this is our list of upcoming masterclasses. And if there's a topic that you don't see there that you'd like to cover, just drop us an email at info@vicoadvisory.com and we'd be delighted to assist. And again, if you could also sign up to our newsletter for monthly insights, it would be really good. And we give a high level update on what's happening in the marketplace in this. And this is, again, any questions, suggestions, or feedback, we are here at info@Vico Advisory. So thank you all for taking the time today. Hope you really enjoyed it and found some useful information from us at Vico.
Thanks, guys. We really appreciate your time today and all of your engagement and questions. So have a great day and hopefully see you at the next one.